Going all in could be a fast track to get rich, or a fast track to get destroyed. But what if you went all in on one dividend ETF? Today I ran 3 simulations and one of them turns into an absolute monster. Cue the classical music and let's run the numbers. Welcome back everyone, I'm the Swedish dividend investor. Like I said in the intro, I want to run an experiment on going all in, or as the kids say, YOLO. Let's jump right into it and do the first thought experiment. Now, I would never recommend anyone to go all in one asset. That is very risky. But sometimes I get intrusive what if thoughts. We are going to be using a dividend reinvestment calculator. We will add some variables for this. In every scenario, I would go all in with my portfolio value at around 150k US dollars. For this case, I will enter a 0% dividend tax, but if I do have to pay a withholding tax, I will enter it. We will do 10, 20 and 30 years invested for every case. The compounding can be monthly or quarterly, depending on the asset. I can save slightly above $1,000 per month from my salary, sometimes more. And if I also take out dividends from my own business, I could get up to around $2,000 per month on average. So let's say annual contributions of $24,000. I will also summarize and go through all the results in a spreadsheet at the end. Let's start out with PFFI, HAN ETF, Infrastructure Capital Preferred Income ETF. This is a monthly paying ETF. It is actively managed and they hold preferred shares. Long story short, preferred shares usually pay a fixed dividend and they usually have a trading price of around $25. Like I said, they pay monthly and the yield is about 8 to 8.25% currently. I pay 0 taxes on ETFs domiciled in Ireland. For the dividend calculator, we will go with portfolio as investment type. Monthly distributions, DRIP, that's the reinvestment, yes. We will enter 150k starting principal, annual contribution of $24,000 per year, 0 tax, yield of 8.25%, 0 growth for both the share price and the dividend. Is this likely? I would say it's more probable than having some growth here. First, we will check how it looks after 10 years. Ending balance of $698,534. A total return of 79.11%, so an annual return of 6%. Here we can see the annual dividend income, $59,858. That's almost $5,000 per month. Sweet. We can also see about half of the portfolio value comes from the reinvested dividends. Now let's do 20 years. Ending balance of $1,946,697, almost $2 million. A total return of 209%, so 5.8% annually. Now the dividend income here is $166,816, so $13,900 per month. And we can see the dividends along the way contributed $1.3 million to the portfolio value. Let's see how 30 years will look like. Ending balance of $4,786,827. Wow. Even with a lousy investment that doesn't grow in value, just reinvested dividends. A total return of 450%, 5.85% annual return. A yearly dividend income of $410,193. That's $34,182 per month. The dividend contributed $3.9 million to the total value. Very nice. For the next example, let's go with a more moderate investment. VDIV or TDIV. VanEck Morningstar Developed Markets Dividend Leaders ETF. In my eyes, one of the best European dividend-focused ETFs. They hold about 100 companies and they focus on consistency and sustainability in dividend payments. There's also some bullshit ESG screening for those 2 people who care about that. The yield has gotten a bit lower, around 3.5%. But for argument's sake, let's say it's yielding 4%. Not unreasonable, since that's what the average yield is. They pay quarterly, and the ETF is not domiciled in Ireland, but the Netherlands, so there will be a withholding tax of 15% for me. So I've changed the distribution frequency and tax rate. Dividend yield 4%. Now this ETF has dividend growth, and it's between 4 and 10% annually for the last 10 years. So let's go with 7%. For the price appreciation, it's a bit tough, since they had some stellar years behind them. Let's be a bit conservative. Let's go with 7%. So for returns, we have 4% from the dividend and 7% from the appreciation per year. We are starting with 10 years. Ending balance of $796,197. A total return of 104.15%. So a 7.4% annual return. A pretty respectable $32,328 in annual income. So that's $2,695 per month in income. Nice. The dividends contributed $157,810 to the total value. So here we can see the appreciation doing the heavy lifting. Now we do 20 years. Ending balance of $2,542,323. 303.54% total return. 7.22% annual return. Now the dividends are really getting up there. $103,228 per year. That's $8,600 per month. The dividends contributed $742,947 to the total value. What does it look like after 30 years? The ending balance is now $7,260,621 with a total return of 734% and an annual return of 7.33%. The annual dividend income is now almost at $300,000, $294,810, so $24,567 per month. The dividend have contributed $2,482,790 to the total value. Pretty awesome. Let's do another what if scenario. What would happen if I went all in on BDCs? Now, we don't have a BDC ETF in the EU, but I have built a portfolio with BDCs, so let's use that one as a fund. We will use the same portfolio value, and we will keep the quarterly dividend since most pay quarterly. We keep the tax at 15% as well. We will change the yield to 10%, and we will actually go for -2% dividend growth and share price per year. Before I hit the button, pause the video, comment down below, will this portfolio have less or more income than the other portfolios? Alright, let's hit it. So for the 10-year calculation, we got an ending balance of $619,110, a total return of 58.75%, annually 4.73%, and look at that dividend income, $64,271 or $5,355 per month. The dividend contributed $348,538 to the total value. Let's take a look after 20 years. Ending balance of $1,526,861. A total return of 142.36%. Annual return of 4.53%. And the annual dividend income is sitting at $158,507 or $13,208 per month. The dividends contributed $1,364,367 to the total value. Now, after 30 years, The ending balance is now $3,283,406, 277.4% total return, annually 4.53%. The annual dividend is now $340,859. And here's the insane part. Dividends contributed $3,671,441 to the total value, which is actually more than the ending balance. So, even though we are losing money, in a sense, the income makes up for it. I mean, negative 2% dividend growth and a price decline of 2% per year is a lot. Before we move on, if you enjoy my work, don't forget to like, comment and subscribe. Thanks! So now that we have some data, I put them in a spreadsheet so we can get an overview. And here are the results. You might wonder about the coloring scheme. I've categorized them with lime if they are the best choice and red for the worst choice. The neutral color is somewhere in between. What conclusions can we draw from this? I would say, if we are looking for total return, then TDIV or VDIV wins. Not only after 10 years, but by far after 20 and 30 years. However, the income is less than the other two. It's still impressive though. Looking at PFFI, it seems to be the choice for income investors. I mean, almost 60k in annual income after 10 years. That's pretty good. And the income holds up pretty well when we use the inputs from before. That's very important to remember. We don't know the future. All we can do is to guess and to be somewhat conservative. The end balance is also pretty strong with PFFI. Then we have the BDC portfolio. Worst performing on end balance, and the income gets beaten by PFFI in the later years. This sucks. Or does it? That depends on the goal. If the goal is to get the highest income possible in the shortest amount of time, the BDC portfolio actually beat both PFFI and TDIV. It's almost twice the amount of income compared to TDIV. So, different tool for different jobs. Here I would say we are splitting hairs between the hypothetical BDC portfolio and all in on PFFI, since the income from PFFI is pretty close after 10 years and beats it going forward. Now let's take this a step further. Now we're going to take out the dividends and retire. I've gone with the 10-year result, since I don't want to retire in 30 years. In 10 years, I'm a few years away from 50. So let's say I'm 50 when I retire. The average lifespan for a Swedish male is around 82 years. Sounds harsh, but I only have 32 years in retirement then. We will turn off the drip, enter the ending balance of the BDC portfolio, $0 contribution, and we will keep the yield, dividend growth and share price growth the same, and let's project 32 years forward. Ending balance of $324,341, a total return of negative 47.61%, so negative 2% per year. The annual dividend is $33,670 or $2,805 per month. Yikes. With a 2% inflation rate 32 years in the future, that would be like $17,866 per year today, or $1,488 per month. Could be hard to live on. Maybe I get some small lousy state pension. However, during the first 20 or so years, it doesn't look that bad. At year 20, I would still get 43k per year in income. So let's do TDIV next. I've entered the numbers and let's check it out. Look at that. Ending balance of $6,939,072. A total return of 771.53%. Annual return of 7% and a staggering $281,754 or $23,479 per month in dividends on my deathbed. That is insane. We don't even have to calculate the inflation on this, since that's a lot of money. If the inputs plays out, the 7% growth of the dividend and the share price, I could go all in on this and then live small on 32k per year in dividends and then just watch it grow. But that's a big if here. Let's do PFFI. I'm pretty excited. I'm writing the script as I go, so I don't know the final results. I've changed the distribution frequency and tax rate, as well as the yield and growth. Here is the crazy part. All else equal, if the distributions and value stays flat, it's all the same as when I retired. The ending balance is the same and the annual dividend is the same. With an inflation rate of 2%, my future income on my deathbed would be equal to $31,762 today. That's $2,646 in today's value. I could live off that, I guess. Now, these are highly simplified scenarios, with the growth staying the same year after year. Nothing works like that, but I would say we weren't that exuberant with the numbers. Heck, I would even say I was somewhat conservative. But we all know, crises will happen. Dividends will get cut, the market will fall by more than 50% at least a couple of times during this time period. But it's fun to do thought experiments like this. Anyway, I jotted down the results in my spreadsheet. At the bottom we find the BDC portfolio. Worst in value and income. Middle of the road we have PFFI or ASWN. The clear winner is TDIV or VDIV. So what conclusions can we make from this? I would say not many. We don't know the future, and projections like these always look wonderful. But what I can conclude is that if I want to retire as soon as possible, I should actually go with a high yield. It is a bit risky, but it's faster, but you pay for it in the long term. For me, that's not a problem. I don't have children, and I'm not planning to get any. So, what good is a multi-million-dollar portfolio for me when I'm lying on my deathbed? I guess you could say it's a margin of safety along the way. But I can also invest more before retiring. There is also no guarantee that TDIV will do this stellar over 30 years. I think what I learned from this experiment is never go all in. Sure, it could pay off handsomely, but it might as well come back and bite you. With that said, I hope some gears started to turn in your head. Let me know if you found this interesting, and don't forget to like and subscribe if you enjoyed it. It really helps the channel. I'm the Swedish Dividend Investor, and I will see you guys next week. Until then, stay smart, stay patient, and keep stacking those dividends. Ha det gött!